Hey, in today's webinar, what I wanted to cover is module 4 from my training on apartment investing, and we're going to cover the acquisition process, the whole process from beginning to end of going out, deciding to get into apartment investing, what that's going to look like, all the way through submitting an offer and actually getting that deal. We're going to cover a whole lot of information today, so make sure you take notes. You can always come back and watch this video later, but just a lot of really good information for you guys. First of all, if you don't know me, you've never met me, my name is Stephen Lee Thomas. I am a multifamily investor. I'm a business coach. I'm an entrepreneur. And I'm a podcast host. A little bit more about me and my partners. My partners and I have been able to purchase about 3,200 units collectively, and most of those are large apartment complexes. We've had a number of those go full cycle. So you can see here on the screen a number of examples. Um, and some of those we've been able to go full cycle on, and we've been able to average about 88% return on investment for all of our passive investors. The way we do this is through a syndication model. So we've had pretty good success. We've been doing this through good times and bad times, and we've got just a lot of experience with apartment complexes. So an overview today, really quickly, of what we're going to cover is this is for guiding the buyers and investors through the process of purchasing or investing in multifamily property. I want to emphasize the importance of continuous learning in personal and professional growth, sharing insights from your own career and journey, including the mistakes of thinking learning ends after a formal education, and really just a deep dive into the formal understanding of the multifamily acquisition process. The first thing that I want to emphasize, really, there's a lot of information I'm going to share with you here, like a lot of information I'm going to cover today. And I am a big believer in continuous learning. And the main reason why you want to be a continuous learner, especially in something like this, is that the more you know, it's going to reduce your risk. So I want you to get in that mode that you're always a student and you're always going to be in this growth mode, because as much experience as I've had, I've gone through this most recent market cycle, and there's none of us were really, prepared for it. So just being open to how things can change quickly, and that you need to be able to grow along with it and listen to other people and get guidance when you need it. I do a lot of coaching, and the thing that I've realized with coaching is you have to be open to really changing the person that you are. In order to become the person that you want to be, you have to change the person that you are today. And that's not a bad thing. You're growing into a different, better version of yourself. And the biggest takeaway from all of that is really this growth mindset, this idea that learning never stops. And I'll go back to, if you take the time to invest in yourself, you're just going to reduce the risk. And I think that's very true when it comes to buying apartment complexes. And the reality of it is, if you're one of the people that's listening to this training, you're one of the people that is actively investing in your education. The next thing I want to cover in this acquisition process, so you start with really the mindset, is there's a lot to learn. This is not an easy process. This is not an overnight process. You're buying and selling businesses on a large scale. Even if they're small apartment complexes, you're buying and selling businesses on a very large scale. So I like to start out with the idea of SMART goals. You may have seen this before, you may not have seen this before, but SMART goals are like this. You have specific, measurable, attainable, relevant, and time bound. So I'm going to see if I can tie this back in to what we're going to be talking about today. Um, I've had a chance to chat with a lot of you, and when I ask what your goals are, you say, I want to buy an apartment complex. And several of you have this goal of buying 100 units. I want to get into 100 units. So I want to put that in perspective for you from a SMART goal example. So if you want to buy 100 units, let's say that all in, you're going to buy this apartment complex or multiple apartment complexes, we'll just use one apartment complex for this example. It's $130,000 per door. That means for a 100 unit, there's going to be $13 million to purchase this apartment complex. Now, as of this moment in time, I was just looking at some deals yesterday. I know that debt quote, lenders will lend up to about 65%. So that means you need to come up with 35% of a deal. If you're buying a $13 million deal, that means you need to have $4.5 million in capital. If you're raising money to do that, not all that's going to be your money. And each investor is investing $50,000, that means you need to have 90 investors and you probably need to have 2 to 3 times that amount. So right there, you can see very specifically, it's easy to say, I want to get into 100 units, but when you start to break that down, when you start to get very specific about it, you start to see much more what's required, the amount of dedication and time of learning to this process. So I'm going to go down through this a little bit more so we can continue to be specific. So let's say I want to buy this 100 unit deal. It's going to cost me $13 million. I need $4.5 million in capital. I've got to probably have a couple hundred investors that can invest $50,000 each. Once you start doing this, you'll find investors that are open to investing much more than that. But being more specific, I want to do this in the Dallas market. I'm looking at properties between 1980 and 2000 with a median household income of 60,000 or higher. So you can see right there, that is very specific. I'm becoming very specific with my goals. You need to be that specific with your goals as well, because it's going to help you achieve your goals much easier. Now, measurable. Let's make this measurable. For the sake of this example, I'll just say 180 days. I want to be able to do this in 180 days. If you said you wanted to be able to do it in 90 days, I'd say unless you had a deal that you were just about ready to put under contract, it'd be pretty hard to do in 90 days. If you're just getting started, I think it's very achievable, but you might want to give yourself closer to that 365-day mark just because of the amount of education it's going to take and the relationships you're going to have to build along the way. Um, Attainable. Now you have to think, can I do this on my own or will I need to work with other people? You can make it happen a lot of different ways, but you might have to look at it different than you are today or prior to this training. Is it actually attainable? And if it's something you can't do on your own, then you can absolutely do it with other people who have done it, have a proven track record. You can bring people in to help you out. Relevant. So relevant, this is where you make it personal. How does this move it closer to your goals? So if I get this property, it's going to generate, $5,000 a month for me in income between the asset management and the GP split that I'm going to get. So you need to take a look at what your overall goals are, and that's how you make it relevant. And then as far as the time bound goes, I'll go back to the 180 days. So just thinking about that, you can, because you're going to be watching this as a recording, you can actually pause this recording and take a minute and put together your SMART goals and see what that would look like for you. And I would say even use the about 130,000 all in per unit and see what works for you. So take a moment, pause, write down your SMART goals, and then come back. Okay, now that you're back, let's talk about, for an example, business plan. You've got some of that. So with your SMART goals, you should be able to answer these questions. How much money do you need? What are you going to do to get that deal? Are you going to partner with other people? Are you going to seek coaching? Are you going to get on a plane and go check out some other markets? Are you going to go to networking events? What are you going to do to get that? How many investors are you going to need? And figure $50,000 an investor. How many investors are you going to need in order to help you acquire that property? Guarantors, if you're not familiar with that, once you get into the commercial real estate space, it's 5 units and above, the loan has to be, you have to have somebody sign on the loan or multiple people sign on the loan, and they're called guarantors, and it's going to be equal to the loan amount. So you and the people that are acquiring the property need to be able to sign on the loan, and they need to have net worth and liquidity close to the loan amount. And if you can't do it on your own, then you need to find people you can partner with to do that. What are the property characteristics, the size, location, class, year, et cetera? So those are some of the examples that I mentioned before, like where is it? What market? And how big is it? And is it an A or B or C class? And what are the years? So you should be able to be that specific with the properties that you're looking at acquiring. Next is the business model. My recommendation is that you do some type of a value add. If you're new, I wouldn't recommend a heavy value add, but is it going to be value add or is it going to be yield? And yield is basically where you have operational issues that need to be streamlined. And sometimes you have mom and pop operations where you can come in and make everything more professional. That's an opportunity there. But most of the time, it's a value add opportunity. And then how are you going to do the financing? There's multiple financing options out there. We'll talk about that in a future training, but there's different loan types you can get. If you're looking for something smaller, maybe you're looking for seller financing. Everything that I do is all using the bank, but even with that, there's bridge debt, which is variable rate loans. And then you can also look at different loans, and they're based off of the treasuries. So you would have the 5-year, 7, and 10-year treasuries. So what type of finance you're going to be using. And then property management strategy. And this is where I recommend everybody bring in professional property management and they don't try to do it on their own because you want to free yourself up to be going out and finding other deals to be doing this. So there's just an example of when you have clarity on your goals, you will know very quickly what it is you're looking for and all of the things that you need to be working on to achieve those goals. So without having that clarity, you're not going to be able to follow through in the business plan. It's just not going to happen as easy for you. So that's really where you need to get started. Now, from there, we're going to go into step 3 of building the multifamily acquisition process. Or I should say the multifamily acquisition process, and that's building a team. And the team, this list is not comprehensive, but it's pretty close. If you've never done this before, you'll see as I go through this, there's a lot of moving pieces. You likely will need a mentor to do this. Even if you had all of the education that's out there available on the internet or in books, having access to someone experienced is going to help you move forward much quicker and answer questions for you and help support you along the way. The other person that you're going to need is a broker. Brokers are huge. I talk a little bit more about that later in the presentation, but the broker, that's where you're going to find most of your deals. I'd say probably 80% of the deals that you're going to take a look at are going to come from a broker. Because everything that I do is SEC, Securities and Exchange Committee regulated, we have SEC attorneys that we work with, and they help us structure the deals, and they actually work with the lender legal team. So we absolutely have attorneys involved. Loan brokers. Now you can go out and find. You can work with lenders directly yourself, but loan brokers is a great option because you'll have one person you work with, and they will go out and they will connect with multiple lenders and play that to your advantage. You're also going to need investors to invest in your deals if you're planning on buying these larger deals and you don't have the money to do it yourself, you need to get investors to invest in your deals. You also need property management company. They are really the boots on the ground. They make everything happen for you. You create the business plan, they implement it. They are a very, very, very important part, probably one of the most important team members you can have because there's work that goes into acquiring the deal, but once you acquire the deal, you're going to own it for 3 to 5 years, if not longer. And the property management company can really make a big difference. When you're doing the value add strategy, you need contractors that can come in and do the work. So are you going to make the relationships with the contractors, or are you going to work with a property management company and maybe they have contractors that can do the work? And then the last piece down here is what are the partners? Now, I've got other training on this, but you have partners such as who's going to be boots on the ground, who's going to underwrite, who can help raise capital. Maybe you have partners who are KPs. Maybe you have, there's the key principles. Maybe you have partners with experience who can guide you on this. So then you have your partners that you're going to be working with. So that's really step 3 here is building that team. Now, step four, I'm going to talk about this because most of you are coming from a single family background. Single family homes, when you go out and you look for a home, you have to get pre-approved. And they take a look at all your bank statements and look at your credit score, all this stuff. You actually don't have to do that in the apartment investing world. So typically what happens is you're using your assets and resources of your own and along with your partner. So there is no pre-approval stuff you need to do. You can go out and just start looking at deals and you can get all the way through the offer process and even getting your offer accepted. And there is no pre-qualification, pre-approval at that point. So really, this is a goal setting step, and I've got that right here. This is really more of a goal setting step. This is to help you figure out where you're at and also help you work on building the team and focus on creating your personal financial statement. If you haven't done something like that, reach out to me. I can provide you some documentation to help you create a personal financial statement. But that will be required when you go to get the loan. And what you need to do through here, I'll just step through this really quick. You basically are looking at your income and your assets. You can go I use Credit Karma and I've had it for years. And I just use that just to kind of keep the pulse on my credit score. Um, as far as employment goes, when you do the apartment loans, they don't verify employment. Like I said, they're looking at your assets and your resources, and then what are your liabilities? And these are essentially the pieces that go into that personal financial statement. But that's what goes into getting pre-qualified. Like I said, there's no pre-approval, but you do need to create your personal financial statement and have that ready for after you get a deal under contract when you're working with the lender at that point. The next thing you need to do, and I'm going to spend more time here, is really defining the criteria, and this will help you with your SMART goals. So, as of the time of this recording, when I'm doing this webinar right now, I have looked in a few different markets. Mostly, I look in the Dallas-Fort Worth area, and I can say a pretty solid B class. They're going for about 100 120, 130, 115 per unit. And that's just where the market's at right now. I think it'll start going up here before too long. Maybe it's even going to go, well, I should say some of the deals are lower than that, but I think that we're pretty close to the bottom. But so you need to look at the overall purchase price, and I generally like to back my way into the purchase price kind of, or the number of units based on the purchase price. So know what your upper limit is for your purchase price and factor that in by how much capital you think you'll be able to raise, or working with partners, how much capital you'll be able to raise realistically. And then you can figure out your number of units. Because this is the information when you go and reach out to a broker, this is this is basically the list of things you're going to share with the broker. You're going to say, hey, these are the deals I'm looking at. Here's the max price or the price range I'm looking at. Here's the number of units I'm looking at. Here's the location. And so that would be even within a specific market. So you need to figure out where the markets are that you want to be investing in. If you don't live someplace, like you can invest in your backyard if it makes sense. If it doesn't make sense, you need to find someone to partner with who can be physically in that location, can be the boots on the ground, or you need to be able to hop on a plane and be able to go check things out, visit the property. The next thing you need to do is figure out the class of the property. Is it going to be an A class, B class, or C class? There's pros and cons to all of them. My advice is a C plus or solid B class if you can find it. The reason for that is the A class, um, there's generally less cash flow in the A class. They cost more to get into. What's nice about it is there's not very much rehab needed because they're newer properties. But what I've learned is that when there's issues in the economy, the A class, they will move into B class properties if it happens. So vacancies happen most quickly in the A class when there's issues with the economy. C class, when there's a lot of inflation, it's harder for them to continue to pay the bills. They have less disposable income. And when you're doing unit renovations, sometimes it's harder for them to come up with disposable income. B class, they have a higher disposable income. And if there's any issues with A class, they move into B class. They don't build B class properties. B class is a nice sweet spot or a C plus. So that's my advice when it comes to the class of property. Your business model. I recommend, starting off with some light value adds, some unit renovations, and then some other things you can do to other income. You can go into totally distressed properties and flip them. You can do it. It's just harder if you're getting started. The financing, we talked about that a little while ago. How are you going to do the loan? My recommendation is stick with your traditional lenders, Fannie or Freddie, but you need to figure out your financing. You need to figure out how much rehab you're willing to do. And I'll give you an example. And I'll talk about this more a little bit later, but on some properties that are older, you may end up with issues with the electrical panels or some of the wiring that becomes a bigger project, or they have boilers and chillers. And if those go out, they're a bigger expense as opposed to if they're individual HVACs, or are you going to be converting from master meter to individual metering? So you need to figure out the level of rehab that you're comfortable with. And then as far as the physical assets, I mean, more some of the things like I mentioned, chillers, boilers versus individual HVACs, pitched roof versus flat roofs. Like, what are some of the features of the property that you're comfortable with or you're not? Once you do more of these, you become more and more comfortable with everything. When you're first starting out, you probably want something that's a little bit more on the newer side. If you've never dealt with boilers and chillers and flat roofs, you probably want to find somebody that you can partner with on that. Um, and then lastly, this is if you're watching this and your goal is truly just to be a passive investor, then what you want to learn is how to understand the projections and start building a relationship with the sponsorship team. So what you want to do as a passive investor is it can be very passive, but you should be studying and learning how to understand the underwriting and the business plan. You don't want to be completely passive. You want to take the time to educate yourself and actually get to know those deal sponsors. From there, we're going to move on to how do you locate a property to even look at? Now you define your criteria. Like, let's talk about where you're going to get the deal flow to locate those properties. Now your team. So this is really more if you're just getting started, this is gonna be a little bit harder, but this is how important partners are. Um, your team, these can be the property management companies you're working with, lenders you're working with, insurance agent, contractors, et cetera. And I can tell you that I have been presented a deal and purchased a deal that actually came from a lender, as an example. And I actually get insights into upcoming deals from property management companies. Those are two ways I'm actually able to find deals. So your team, the team of people that you're working with, is actually a very, very, very good resource for finding deals. Next is LoopNet, loopnet.com. And a lot of you actually heard of LoopNet, and I hear the same thing from everybody I talk to about this. LoopNet, they say, "Oh, I'm always told LoopNet's not good because those deals are bad. They've been on the market for a while. They're not off-market deals." Well, that's all well and true, and oftentimes what you'll see on LoopNet, it's already been sold. But what you can do is go onto LoopNet and you'll find who all the brokers are, and then you can reach out to those brokers, introduce yourself, tell them your criteria, and start having those phone calls with the brokers. So I did that just this last week, and I met with two brokerage firms by looking on LoopNet and finding brokers to reach out to. So fantastic way to do it. The NAA, that's your National Apartment Association. Look for your local chapter there. That's really a place where you could just go start networking if you wanted to. It's not something I do personally. I lean heavily on brokers, but your local NAA chapter is an option. Next is listing brokers. I will put more emphasis on, I think probably 80 to 90% of the deals you're going to get are going to come from listing brokers. You need to focus on building those relationships with brokers. Now, once you've been doing this a little bit longer, then you start building relationships with other owners. But it can also happen. I was with one of my coaching students just yesterday, And she was saying she was talking to some people in her church, and a number of people in her church live in an apartment complex, and then one couple does a property management for the apartment complex, and they mentioned to one of my coaching students, they said, "Oh, the owner is actually getting old, and she's looking at selling off her apartment complexes." So the reason why I'm sharing that with you is you might be closer to a property owner than you think. Once you start talking to other people about what you're doing, you'll start seeing that, oh, there's other owners that are out there, and that might be a good way for you to find deals. As far as the MLS goes, it's not really a great place to look for deals unless it's under 30 units. Yes, there'll be some stuff there, but even that will very likely come from brokers. So I don't personally spend very much time on the MLS. And then the last one is the investor groups. This is just networking events. You go to meetup.com and see what kind of real estate investing events there are, and just go out and network. The moral of the story here, locating properties, is it's all about relationships. So build a big network and build relationships. If this isn't your strong suit, then you need to find somebody who is good at building those relationships. Now that you've got a property, we need to talk about the drive-by for the property. And because a lot of times once you'll start underwriting these deals or start looking at them, you want to find out, like you're going to drive by the property. You want to actually drive by it before you submit an offer. So what would that look like? When you drive by the property, as you start seeing these deals, and I'm thinking of like Zillow, a lot of the deals I see are single family homes on Zillow. The pictures are fantastic, and you go drive through the neighborhood and you're like, there's no way I'm going to live in that neighborhood. So it could be the same thing with the property. That's why you want to do a drive-by. So what you're going to do is, now you define your criteria up front, you start seeing some deals, drive by it, and you're going to say, does it match my criteria? What does a curb appeal look like? If it's not that great, but it matches my criteria, what are the things I can do to increase the curb appeal? That is the first impression any potential resident has at your apartment complex, is that curb appeal. You want to drive by the neighborhood and you want to check out the demographics. Is it the right demographic for the property? Is it the demographic that fits your criteria? Is it going to be a high crime demographic? Is it a working class demographic? For example, if you drive by in the middle of a week and the parking lot is full, are those people working? Like, why is the parking lot full? You should be finding an apartment complex where it's a good, strong working class, and there's not people that are there in the middle of the day. You want to go and see like what improvements could be made at the property. Is it well maintained, or are there other improvements that you hadn't considered? Your criteria does it actually match your criteria? Is it everything that you need there? Does it match your business model for the value add that you're thinking? Is the location you might have your market, but within the submarket in the neighborhood, is it a good location? Is it the right neighborhood for the business model you're trying to implement? And ultimately, do you like it? Do you think it's an apartment complex that you could buy, and would it work for you? Do you like it? Is it something that you want to move forward with? So that's what you want to do with your drive-by. And from there, so 8 is the analysis phase, and I broke this into two parts. There's a financial analysis, and then there's the market analysis. So with the financial analysis, this like I said, it'll be the market analysis next slide, but the financial analysis, this is where you look at the 12-month P&L, profit and loss. This is commonly called the T12. So if you're just starting to look at deals and you want to reach out to a broker and you want to sound like you know what you're talking about, you're going to request the T12. And this is going to be a 12-month profit and loss. And you're going to start looking through this at the income, other income, and expenses. And you also want to look at the rent roll. This shows you everybody who's in the units. It shows you what they're paying. You'll see that same unit side by side. Some people pay more, some people pay less, and why is that? And you want to figure those things out, and it helps you understand how much you could potentially increase your rent. Then you want to start looking at the things you're going to do for rehab and what the budget would look like for rehab. You also need to factor into your financial analysis, your financing. Now, this is huge. Generally, what I'll do is I have a rule of thumb. I'll look at the treasuries, the 5, 7, and 10-year treasuries, and then I'll probably add about 2% or 200 basis points on top of that because there's spread involved, but that's where I'll start. And then once I get far enough down the path, I'll reach out to a lender or a mortgage broker and I'll ask for a debt quote. And so they'll start giving me information on the financing. And then here's the actuals, and this is the T12 and rent roll. These are the actual numbers because sometimes you'll get what's called an OM or an offering memorandum. And there'll be a one pager from the broker that gives you some numbers. But what you want to do after you've done your initial analysis, you want to get the actuals and plug those into your underwriting. And when you do your actuals, you take your actual income and expenses, and then your pro forma, that is your future income and your future expenses. And then what we do is we break that into a 5-year forecast. So we take our current income and expenses, our current we take a look at what we think we can increase rent to, and then the other things we can implement at the property to increase the other income. Is there any opportunity to reduce expenses? And then we forecast that out over 5 years, and then we trend that in with other data that we get from CoStar or other data sources. The next thing we do is we go over into the market analysis. I just mentioned CoStar here. So the market analysis, this is an equally important part of the analysis as is the financial part. The market is really going to help give you visibility into what's happened in the past and what likely will happen in the future. So let me go through these with you. Where can you get this information? You can get it from Yardi or CoStar. Um, these are paid services. What I recommend is that you reach out to the brokers and you ask them if you see a deal and they haven't provided this and you like it and you've done your initial underwriting and you're going back, you're going to go back to them and ask them for a CoStar report. The CoStar report is very detailed. It's going to show you a whole bunch of information. It's going to show you basically all of this information here. And you need this so you can do your analysis because you need rent comps. You need to see in the area what are those rent comps. Now, you can also go to something like apartments.com and look at what rent comps are because those will be listed. Once you get further along, you actually pick up the phone and you call those other apartment complexes and see what they're really charging for rent. You want to look at sales comps, and this is something you will have to get from CoStar. But what have the sales been like in the last several months compared to what they're selling this property for? Demographic information. This is really big, and mostly because of the median household income. If you're going to be improving the property, you're also going to be improving you're going to be increasing the rent. And you need to make sure that the demographic is able to absorb the rent increase when you're doing those renovations. So my recommendation is at a minimum, I would say 55,000 or higher for a median household income within 1 mile of the property. Ideally 60,000, and if you can do it 65,000 or higher median household income within a 1 mile radius of the property. You definitely want to look for a place with population growth. If the area is completely built out, there's not going to be a ton of population growth, but you don't want to see a decline. And you do want to see that there is rent growth, that there has been, and it's forecasted rent growth. And you can get these details from CoStar. You also want to be able to check the vacancy. What does the vacancy look like in the past? You're shooting for ideally, you want your occupancy to be 90% or better. If you can have it at 95% all the time, you're doing pretty good. So you want some visibility into what the vacancy is like, not only at this apartment complex, but what does the neighborhood look like? If your 1 mile and 3 mile vacancy is low, your property is not going to be anything special. It's not that you're magically going to have higher occupancy just because you own it. You need to understand the market. And then lastly is the cap rates. Cap rates are tough sometimes to understand, and they fluctuate within the market. But I think what's most important here is your reversion cap rate. Your reversion cap rate is what is your cap rate in the future? And it's really, really, really easy when you're underwriting to compress your cap rate, saying the market's going to get better, or I'm going to improve the property so much that I'm going to, get a lot of value for it. When you're looking at your future cap rate, you basically want to assume the worst case scenario that you can and still get the returns that you're looking for. So in a future training, we'll go deep into all of the underwriting, and that's where this will make more sense. Just be cautious here with the cap rates that you're not too aggressive with it. You need to be realistic. Um, okay, so now we get into number nine. We've done our criteria. We reached out to brokers. We located the property. We drove by the property. We've done financial analysis and market analysis. And now we actually do the site visit. We have the property tour that we're going to do. This time we've reached out to the broker and we've scheduled a property tour. While you're at the property tour, here's a list of things that you're going to be looking for. What types of problems can you see just by doing a visual inspection? And I'll give you an example. Um, a lot of times what we'll do is we want to see how are the foundations of the buildings, and a giveaway for that is cracks in the side of the buildings, because a small movement in the foundation will actually create cracks in the sides of the building. So that's just an example there. You want to, if you can, check out boilers, chillers, HVACs. You want to check out electrical panels. You want to get into some of the units. You want to look and see around the trash areas. Are there stray animals on the properties? You want to look for problems. Are there trees that are overgrown? Are there roots that are lifting up sidewalks? Are there trees that are too close to buildings? Are there wires hanging from um, cable projects? I've had that issue before where there was wires all over the place from a cable company that came in and just left a mess. So you want to be looking for problems while you're there. At the same time, if there's problems, there's opportunities. And this is where doing the drive-by, get familiar with the neighborhood, you may see some things they're doing at another property that they're not doing here. Those are opportunities. That might be private fenced-in yards. That might be covered parking. That might be putting in pickleball court, something like that. So you're also looking for opportunities while you're there, and problems oftentimes are opportunities. Oh, another example is a dog park, a playground for kids. Those things create spaces for families to hang out, and the reality of it is, it's families that live at a lot of these properties. You want to check out the exteriors. Like I mentioned, cracks in the walls. You want to look for paint. You want to look to see what kind of condition the roofs are in. Are things overgrown? And then you want to look at interiors. You want to get into a handful of units. You're not doing a full due diligence. You're just doing the property tour, but you want to get into the interiors. You want to understand, is there a value add opportunity? Have they been well maintained? What is your opportunity there? Check out the office. The reason why you want to check out the office is because I mentioned earlier the curb appeal. That's the first impression someone has, is the curb appeal. The second impression they have is the office. If the office looks good, it sends a really strong message to a potential resident. And then how is the staff doing there? You get to decide when you buy an apartment complex, what staff if you want to keep the staff or bring in new staff. If it's great staff, I'd say leave it alone. If it's not great staff, then bring in a different property management company. There is no issue there. But how does the staff greet you when you show up? Um, get an understanding for the amenities, and amenities can be things like pools. It can be the clubhouse, but it can also be, are there washers and dryers inside of the units? Is it a smart home, meaning sometimes they have smart locks, they have smart thermostats and other things like that? Is there property-wide Wi-Fi? What are the amenities that are there? And then once again, as you learn to do the market surveys, you'll understand what the opportunities are to implement new amenities at the property and increase the income there. What are the utilities like that are there? Is there an opportunity to change providers? Is it all bills paid, meaning that the property pays for everything and then they just don't get the opportunity to bill back, and that's included? Or is it individually metered? You need to understand what the utilities are there. And then what is the other income? And I mentioned a number of these already. Can you implement Wi-Fi? Can you implement cable? Can you do covered parking? Can you do reserve parking? Can you do private yards? Can you do valet trash. There's a lot of things you can do when it comes to other income. There's package lockers, vending machines, all kinds of other things. So, what are they doing for other income, and what could you be doing? And then what you need to do here is, what value can be realistically added. The reason why I say this is, you just because you build something or improve something doesn't mean anybody wants it. And I've seen this happen at my properties before. Is we've experienced this where we've with the demographic had people come in and say, look, like I don't really care about the really upgraded unit. Like I just need a place to live. Like I just need a place for my family. And I don't have the extra money to pay for the upgraded unit. That is a reality sometimes. We did a business plan. We were going to put in covered parking. Nobody wants covered parking. Like nobody wants to pay for the extra covered parking. So it's easy to get in the trap when you're underwriting to think, oh, I can add all of these things, but if the market doesn't want it and they're not going to pay for it, it's a waste of your time because people are not going to pay for it, and it'll lead to poor collections. You won't get as much revenue as you'd like, and you're going to get into a bad deal ultimately. So specifically, I went through a lot of that already, but you want to walk the exteriors of the buildings. You can do this after the tour. You want to see the amenities, the pool, landscaping, laundry, parking areas. You want to see the cars in the parking lot and the clientele. Stay there long enough to check out the cars in the parking lot. It'll tell you a lot about the demographic. Hang out by the front office and see the people that come in and out. You will see exactly who it is that's living at those properties. I guarantee you. On the interiors, you want to see a few of the interior units, absolutely one of each floor plan. You want to see the office and any common areas. When you're chatting with the staff, and you'll get to do this on a tour, ask them this question. This will give you a lot of insight. Ask them, what would you do if you had $250,000 or $500,000? Like, what would you do to this property? And I would leave it pretty open, like pretty open-ended like that. And a lot of times they'll tell you, oh, I would put in the dog park. Oh, I would fix these units. I would do renovations. Oh, a lot of people come in and they ask for this. That is a low-hanging fruit that you can get information on to help you build your business plan. And then ultimately, you want to find out, does it actually match your criteria? And it really gives you the opportunity to build rapport with the broker and the seller. So now you've gone through all of this. We're up to the point where you like it, everything looks good, the numbers look good, and now you need to submit your offer. Specifically, what does an offer look like? So there's a 1 to 2 page letter of intent. So when you put in an offer on a commercial deal, you'll submit it to the broker, and you'll say who you are, who you're partnered with, and generally you'll attach your resumes with it. Here's what's really important. When you underwrite a deal, and I was just coaching somebody on this a couple days back, when you underwrite a deal and you submit an offer, 100% of the time, what you submit as an offer and what you acquire the property for is different. You will almost always acquire the property for more than you submit in your offer. So you have to leave yourself room to go up. Now you can't come in super low or no one's going to look at your offer. You're not even going to make it to the seller to look at the deals. But you have to understand that you cannot come in with your best number because you will not be able to get the deal because you're going to have to pay more for it. When you submit your offer, you need to be able to say, here's the money that I'm going to put down. And it depends on the market cycle. And when it's a seller's market, your money's going to be hard. And when it's a buyer's market, you're less likely to have the money be hard. That's your earnest money. So you may have to put down $100,000, $150,000, $200,000, depending on the size of the property and the cost of the property. But what you can do with the earnest money is you can still say it's hard with exceptions, meaning if the seller defaults, if the seller backs out for any reason, you should be able to get your money back. If there's an environmental study and it comes back and there's an issue, then you should be able to get your money back. If it comes back that the title is not clean, then you should be able to get your money back. There's some things that are out of your control. And so I think that's very fair to put into your LOI, your letter of intent. Um, and then the other thing you can do is you can basically say, well, part of my money goes hard at this point, and then the rest of it goes hard at another point. So you could say part of it's hard now, and then after we do our due diligence, which that's the feasibility period, the due diligence is when you do your property inspection, you go through every unit that you can. You say I'll put some hard now, and then after we do the due diligence, the rest of it will be hard, and you won't. It's non-refundable money. So the feasibility period, that's where you do the due diligence. And the best way I can explain that is if you've ever purchased a home, someone comes in and they do an inspection, and it takes them half a day or so to go through everything. They turn on all the lights, they run the dishwasher, they run, they open the fridge, everything they can look at, touch. They check all the fascia and see if there's any dry rot. They check the roof, all that stuff. Um, so you have to do that to every single unit you can get in, every building that you can touch, you've got to do that. And typically it's multiple days and there's a team of people that do it. It's very involved. That's a big opportunity, and I'll talk about that here in just in a moment for negotiating. When you get that back, there's going to be this huge laundry list of here's all the things that are broken that need to be fixed. Here's how much it would cost to fix them. That's an opportunity to negotiate. Like that's, once you've got the deal under contract and then there's these issues. Another coaching client of mine said that they'd done this property inspection and then they found an issue part of the property. There's a septic pump. I can't remember the name, the term, but where they have to pump out all of the septic out to the city and they have to replace the whole thing. It's like $600,000 to replace the whole thing. So they found that during their feasibility period, and they've gone back to the seller and said, we need you to adjust the price of the deal. Long story short, they were actually able to negotiate that. And so that's really the example for negotiating a contract. Then you have a financial contingency that's involved there. Like, you could say my money is going to go hard, but it's also dependent. Can I come up with the money? Can the bank loan on this? When you submit your letter of intent, it's very common to submit it with your resume, as well as submit proof of funds. And proof of funds just is, can you put your hard money down? It does not mean that you have to show all the capital you're going to be raising, how much money you have in your bank account. It just means, do you have the money to put down on this deal should the seller decide to go with you? And at that point, you need to know if you have co-sponsors and it's your resume. And if you need other people, your co-sponsors or partners, then you're looking at their resumes as well. So that's really what goes into an offer. Now, let's say they accept your offer, then you negotiate the contract. And what I was just describing was you do the due diligence, you do all of these things, but once your letter of intent is accepted, you're under contract, you actually still can negotiate the price. Um, it's pretty common. Sometimes we'll do as a seller credit. They might not negotiate the price of the deal, but there is an opportunity still to negotiate the price after. So just know that when you go into a deal, you got it under contract, you can negotiate that deal depending on what you find. So I know that's a lot of information. I've been going for almost a full hour now, but I'm going to go back to, I want to emphasize this. As you can see, the learning really never should stop on this. And you need to commit to learning this for the long term, just because we'll go back to the more educated you are, the less risk you have. So take the time to invest in yourself and take the time to learn all of these things. Now, I know it's a lot of information. So what we've done is we put this into a flow chart for you so that you can reference this. Now, I use this with the people in my coaching program. We use this. And so I'm going to walk this through. And if you're not in the coaching program, then you'll just skip this part where it says review with coach. But so we'll go back. So we'll start here. Set your goals. I mentioned that. So set your goals. What does that look like? Start building your team, partners, and your co-sponsors that you're going to need based on your goals. Pre-qualify, understand your net worth and liquidity requirements, and then you're going to define your investing criteria. I have my students bring that to me, we review it. And as long as everything's good, then we say, cool, and they'll start reaching out to some brokers. And then that's where they go out and they look on the MLS, LoopNet, commercial listings, so on, and they find brokers. Then they start getting the details about these deals, the OM, T12, and rent roll. So then they'll do initial underwriting review, underwriting spreadsheet analysis. Once they do that, they'll send it over to myself and I'll review it and I'll give them feedback. they'll tweak that and implement that. And if everything makes sense, then it says deal doesn't work, but actually it says it should be if the deal does work. Time to arrange a property tour and a site visit. Let your broker arrange if using let the broker arrange that. So if everything works out, then what you want to do is you want to do a drive-by and you want to schedule a property tour. So you do a drive-by, you do your market analysis, your preliminary due diligence. You're going to get the industry market and property data review, all of that, and then you update your underwriting. At this point, once you're far enough along, that's the point where you engage with a property management company, um, loan broker. This is when you're going to bring in the vendors. All of this point here, all of this, you're really just working with a broker and it's pretty lightweight. I don't recommend you reach out to a property management company to start looking at your deals if you're not getting serious about a deal. You don't need to start working with lenders unless you're starting to get serious with a deal. There's a lot of things that you don't want to be wasting people's time if you don't have to, because they're going to not want to work with you. You're going to burn them out really quick. They want to work with people who are serious. So only pull in your vendors and people you're going to work with once you're pretty serious about a deal. At that point, if you're working with me, I'd review it and we would say, cool, let's submit an offer. Then you submit the offer, negotiate, and if everything's looking good, then you would start to bring in your attorneys or potential KPs, and then you negotiate the contract. You do your due diligence inspections, your lease audit. You get your attorneys involved again here, and then boom, now you're closing the deal. So the reason why I went over all of that is because I shared a lot with you, but this is really the process flow that you can follow to buy those deals. So closing thoughts here. First of all, there's a lot of information here. This one slide is going to give you a whole lot of information to start outlining everything, but there's a lot more you need to learn along the way. So you need to just open yourself up to learning. Adopt the mindset of continuous growth, and that's going to lead you to greater success, not only in multifamily investing, but also in life overall. And then lastly, if this has helped you and you know where you want to go and you really want to get there, and if you're ready to take that next step, then set up a coaching call and we'll do a one-on-one. We'll take a look at where you're at, where you want to be, what your obstacles are. And then if I think you're a good fit, then I'll let you know how I can help and how we can get you into an apartment deal. So there'll be a link down below this recording so that you can schedule that call if you're ready. If you got any questions, feel free to reach out, and hopefully you found this very useful, and I look forward to chatting with you soon. Thanks. Bye.